It is a one-way transaction, and they're not going to keep you informed of what's going on. But the beauty of it and why it's so significant to me is it tells me that the public is waking up. And that's the last bit of confidence there is to lose. You want to be in position before that last little bit of confidence is lost, because that's when the hyperinflation becomes apparent.
Hi there. Today we're diving into crucial insights from financial expert Lynette Zang. Lynette reveals how banks are diverting excess liquidity to dividends and stock buybacks, which could leave us exposed in the next financial crisis. She also explains how rising interest rates are pushing more people into debt and increasing credit card defaults. Let's explore what these financial strategies mean for all of us. So, let's start the video now.
The banking crisis is unfolding. It never went away. And what happened last March, April, well, a year ago, right, with Silicon in 2023, with Silicon Valley Bank and the other regional banks, was anything fixed? No, it was buried over or covered over. But on top of that, our system became weaker and more fragile. And when you feel safe, because after all, your bank has FDIC insurance, this crisis unfolding so that you can make educated choices that put your best interest first, and you can get out of the way of this train wreck, because it is happening. It's not something I'm waiting for. So let's go back for just a second to the aftermath of the regional banking crisis. And rather than fixing things, what did they do? Bank lobbying climbs nearly 20% ahead of new Fed capital rules, because we don't want to change our behavior. We simply want to change how those are accounted for. 20% the bank lobbying, because they're trying to fend off new regulations. They want business as usual because they make their money from using your deposits as their equity to trade with. Is that okay with you? But the increase in lobbying activity came amid calls for increased scrutiny spurred by crisis that undermined confidence in the banking system. This is a con game. It is all about confidence. I lost confidence in the system such a long time ago because I lived in the belly of the beast and I saw what was happening. But now, after the 2008 crisis, in Dodd-Frank, we set up stress tests for the bank. That too was about confidence in the banking system, not fixing the problem. So what happened in 2023 was not new or unusual. It was an offshoot, and as is the inflation and all the other systems that are breaking down, an offshoot of what happened in 2007 and 2008. But you can feel okay because every single one, in fact, 31 of those banks, big banks, can weather a hypothetical recession. And remember the last stress test, when they didn't take into account the fact that they were raising rates? That frankly makes no sense to me or to anybody else, but let me just keep going and you'll see what I mean. Now the results paved the way for higher dividends and more buybacks. So what does that mean to you? That means that any of the excess liquidity that they're holding in the system, there's a certain limit, but they can send that out in dividends, and they can use that to buy back stock. And that means that excess money is not available when this next crisis hits. And so we taxpayers, again, will have to pay the price of their abuse, really. Because all of this higher for longer, and we've gone over this so many times, right? Higher interest rates means market value down on all of their debt instruments. Bonds, mortgages, auto loans, credit cards, all of that stuff. It is all debt and it is all underwater. And with the raising of the rates, that didn't help. So results paved the way for higher payouts. Good for them, not for you or me. So they're looking at an increase in credit card balances and losses. So we know this. People are putting their basics, food, on credit. They can't even feed themselves. And defaults on credit cards is growing. So that's a loss to the banks. Corporate credit portfolios have become riskier because they're having trouble reestablishing new loans to pay off the old loans because they can't pay it off out of earnings. So those portfolios, all those zombie banks and a zombie bank, just to define that, is a bank that at least 3 years could not pay all of the interest on the debt that they were carrying, forget any of the principal, but they couldn't even pay all of the interest from their earnings. Oh my goodness. So what have the banks been doing? They've been loaning them more money so that the losses did not show up on their books. But that makes these corporations, these zombie corporations, more and more and more risky. Things have gotten a lot more risky. This is from the most current financial stability report from the Federal Reserve. And what you're looking at here are the ratios of runnable money-like liabilities to GDP, gross domestic product, and they have remained above their historical median. And there are all of these different areas. So we think we're safe in money markets. Well, they changed the rules. You are not safe in money markets, in commodity paper and commercial paper, short-term debt. All of these are derivatives, which are just big, fat, unsubstantiated bets. They cannot convert any of these into the underlying assets or instruments. And short-term runnable. So the banks are very subject to runs. This is why confidence is so important, because if you lose confidence in your bank, you're going to pull that money out. But it's not just that bank, because they're all incestuously intertwined. That's what really is making it so critically important that you hold gold and silver outside of the system. It is critically important that you get this done because it's all about confidence, and confidence is declining. And what I find so interesting is how people feel about their bank versus banks overall. And in this survey, they looked at a lot. You have a lot of confidence. You have some confidence. You have not much confidence. So first, they take a look at your own bank. And hey, people have a lot of confidence in their own bank. 28% as opposed to 11% in banks overall. So I'm glad you have confidence in banks because it really doesn't matter. Your bank, your credit union, your community bank, I'm very sorry, is still all part of U.S. bank structure. Some have some, but not much, right? Not much or none. 25% in their own bank and 44%, which is a huge amount. So you're looking at about 90% of consumers have some or not much confidence in the banks overall. This is significant. Plus, at the same time, consumer confidence in the U.S. falls in June as Americans fret about their near-term prospects. And today, or just recently, we had hires or corporations that are hiring jump. Right? So that means more inflation, which is more noticeable about the public, which erodes the confidence even faster. Remember, this whole thing is built basically on layers of confidence. 2008, bank-to-bank confidence was lost. In 2015, central bank to central bank confidence was lost. In 2022, it was Wall Street's confidence in the central banks that was lost. There's only one layer left, and that's public confidence. And when you see people, my son-in-law called me the other day, and he doesn't call me often, but he calls me every once in a while, and he said he had gone to Costco, and he saw this huge long line of people. And so he walked up to somebody and he said, "What's this line about?" And they were waiting for those little 1-ounce gold bars. So what that tells me, do I think you should go buy gold bars at Costco? No, I do not. It is a one-way transaction, and they're not going to keep you informed of what's going on. But the beauty of it and why it's so significant to me is it tells me that the public is waking up. And that's the last bit of confidence there is to lose. You want to be in position before that last little bit of confidence is lost, because that's when the hyperinflation becomes apparent. So let's take a look at who the members of IntraFi are. Let's see. 95% are community banks. 95%. In fact, 23 out of the 25 top banks, which would include, I don't know whether it's JP Morgan or Bank of America or Citi or Goldman Sachs or Wells Fargo, or the list goes on and on. But 23 of the 25, which means some of those very tippy top banks, are also doing this to grow profitability on your deposits. How does that make you feel? 76% of the community banks, community development financial institutions, so it's kind of a quasi-government agency, are also members of this. So they're supposed to be helping the community, but maybe they're putting the community more at risk. What do you think? And 64% of all of the banks in the U.S., so that could certainly also include foreign subsidiaries here, 64% of all banks in the U.S. are members of this, which means that that's all of those banks that can be swapping deposits and using your equity, using your deposits as equity for their trading. How does this make you feel? Can you see just from this how incestuously interconnected everything is? This is the part of that iceberg that you do not see. This is the part of that iceberg that puts you in jeopardy, that puts your wealth, anything that you're holding in the system, in jeopardy. And this, my friends, cannot be bailed out. It's nobody even knows, because remember all of those derivatives as well. That is all they're showing. That 600 trillion in derivatives, what they're showing is what the market has agreed on those contracts. Admittedly, by all of the big banking kahunas, no one knows the true value that's at risk. It's unbailable. And we need a big crisis. And when you're looking at this higher for longer, it always makes me wonder, they're trying to create a controlled demolition of the system. But they need a big crisis to get you to go along.
Thanks for tuning in. Lynette Zang's insights remind us to stay informed about financial strategies and their impact on our lives. If you found this information valuable, don't forget to like, share, and subscribe for more content. Until next time, stay savvy and take care.